we just move on to our next panel. So I hope you have a very short loo break if you're at home, because we keep going here. I would like to welcome Nick Wessemius from FMO Investment Management, Mark Baak of Freemium Fund Management, and George, do I pronounce this correctly, Beukering of Climate Fund Managers. They are here because we want to talk about blended finance, another terminology, a new concept, I should say. For some, it may be not so new anymore, but for a lot of people, it is. What is it? It's a way of blending public money with private money to provide private investors a sort of safety net that makes it easier for them to invest in risky projects. Sorry, I lost my train of thought here because switching from one to the next is not that easy as I thought. But it's a way, it's discussed a lot. You know, any panel or conference, blended finance is on the program. And it's really discussed in the sense that we need this as one of the ways to mobilize the trillions that are needed to achieve the sustainable development goals, halt climate change, or build back better after this horrible pandemic. But according to data, there's an organization, of course, that tracks blended finance deals, that's Convergence. So far, only 140 billion has been committed to blended finance deals. So that's just a drop. But we have here 3 people who are working hard to change that because they really believe in the possibilities of blended finance. They would like to change the conversation. So I really like to, I hope that you are going to be active here, not sitting back like, oh, this is a difficult topic, but raise as many questions for our panel that you have. Also, viewers online, please send your questions through our chat box because they're really ready for it.
Raises the bar.
So maybe it's best to start with Nick. Would you like to introduce FMO? Because we all know FMO as the development bank, but we don't know FMO investment management perhaps so much.
No, of course. And Mike, thank you for having us. I also had a slide on FMO. But basically, FMO Investment Management is a full subsidiary of FMO Bank. FMO Bank is already existing, and it's very small. I'm sorry. We're already investing in emerging markets for over 50 years. It's now quite a big portfolio, and if you look at the bottom right, if you look at the portfolio of FMO, which is about 12 billion, which is also around a bit of a blended finance vehicle, so to speak. If you look at FMO's own balance sheet, which is 8.2 billion, but it's also funded by a bond program. Guaranteed by the Dutch state, so there's AAA money, so we're getting institutional investors in like that. We also have public funds, so that's basically funding from the Dutch government on really high risk, local currency, private equity in fragile states investments. But we also have a mobilized portfolio, and that's really from third parties, and that ranges from commercial banks for FMO. Mobilizing private capital to emerging market has always been very high on the agenda, and we traditionally done that by inviting banks in syndicated loans. That all went well until the financial crisis in 2007-8, where you saw that a lot of banks retracted from our markets. But the profitability of FMO's portfolio was quite stable, so that reacted to, we had reverse inquiries from institutional investors. How does it work? You have a very scary portfolio, you invest in Myanmar, Nigeria, and still you make profit. I think we were the only profitable bank, or one of the only profitable banks in 2008. And it all has to do, I think, with the top right line. And there we get a lot of questions from institutional investors. How does your track record look like? How is your performance? Can you benchmark it? Now, private debt in emerging frontier markets is, of course, very difficult to benchmark. So we took the best of, or best or after of, which is the corporate emerging market bond index, and that's that blue volatile line. And if you compare that to the performance of FMO's loan portfolio, which is the lighter line, and over a long period, since 2004, so still need to update it, I've seen. But this morning I looked at the SEMBI and also at our performance. We actually have the similar performance. So in terms of return requirements, it's quite stable. And of course, it has to do with the left side, that you're active in 85 countries, you're active in 3 focus sectors. It's very diversified and very non-correlated. So whenever there's a crisis in Argentina, for example, it doesn't affect the portfolio in Kenya or in Ukraine. Nothing happens in our Indonesia portfolio. So it's actually quite a stable performance. And FMO Investment Management, we started that in 2013. We started our first fund. At the moment, we have 4 funds up and running. Also one with our friend from Previum. And we also had, it was a startup basically, to work with institutional investors, like both retail, high net worth individuals, but also institutional investors. That's a different way of performing services. But at the moment, we've been reasonably successful. We now have 1 billion in commitments from institutional investors, spread over, private investors, spread over 4 funds, European pension fund, insurance companies, and we're working also on a new initiative, but maybe something more about that later on.
Yeah, please do. We love news. Georgia, could you briefly introduce yourself and Climate Fund Managers?
Sure. So my name is Sjors Beukering. I work for Climate Fund Managers. Climate Fund Managers is a fund management company. We established it in 2016, actually within FMO. I had started working for ABN AMRO 20 years ago, and I missed, it was all about finance and making profits, and I missed the impact. So I then went on to work for FMO and worked there in the energy division for about 6 to 10 years or so. And then we realized is that while we thought there is a lot of interest in emerging markets, especially amongst development finance institutions, the real big boys and girls of this world, the real money is actually largely absent in Africa and in developing Asia. So we thought, how can we bring our, and at the time FMO's experience to the market, and think of fund structures that we can offer to institutional investors, to family offices and others, to bring them to jurisdictions where otherwise they would never go. Okay, so Uganda is a scary place for many. Tanzania is a country that people have to look where it's actually on the map. So that's when we started Climate Fund Managers. The theme is very much climate. So we propose climate-related funds that also have an impact on the development side by virtue of the countries where we invest in Africa, Asia, and Latin America.
Yeah, so he's very modest, but Climate Fund Managers has probably 2 of the biggest blended funds in the market at this moment, and he's going to talk us later to how this is actually structured. But let's first Mark introduce himself and Previum.
Yeah, sure. Mark Baak, I joined Previum 10 years ago to set up the Dutch office, which I had together with Clayton Heineman, its founder. We've got offices in London and 3 offices in Asia as well, 28 people, more than 3 billion in the management. And where we differentiate ourselves from others is that we tend to cooperate a lot with external advisors, or in this particular case, FMO Investment Management. So we were able to set up a fund, the FMO Previum Impact Fund, which was seeded by ABN AMRO Mees Pierson. Jan Willem Hofland, the former speaker, was one of the people behind that initiative as well. And that's how we blend with our fund and together with FMO Investment Management.
Yeah, you do it differently, but we're going to discuss this. Nick, what does blending mean to you, and what would be your approach to blended finance?
First of all, is using a mix of capital in the same transaction or the same fund. So you can look at it in both ways. Indeed, like Mark is saying, our fund is already blended finance because it's co-financing with FMO. So the way we finance loans with our funds is really on a pari passu basis. So you mix private capital, either from Mark's fund or with institutional money in the same transaction. But you also share the same risk and you share the same rewards. What we also see with institutional investors and a lot of mostly insurance companies, that regulation comes around. And that's more about solvency, capital requirements. So if they would like to invest on a large scale, they need some sort of first loss. Because if you look at the portfolio of FMO, and the same goes, of course, for George's fund, it's all single B, double B because of the countries where we operate in. So they need some kind of risk mitigant, and it's mostly in the form of a first loss, to be able to do meaningful sizes, actually. And indeed, yeah, we're hoping to announce a large initiative today, but we're still working on the details, and that's all about regulation, accountancy, all these bits and pieces, which always take longer than you expect. But this is a large initiative, and also that investor mentioned that we can only do such a large amount because there's a first loss involved.
Is this all that time on due diligence and regulation, etc.? Is that because it's still relatively new? Is it something that the regulators, etc., also need to learn more about how it works, just like investors?
I think the regulation is old, but the new part is getting to know about the real risk in our portfolio. We have, for example, our eldest portfolio for institutional investors is 8 years old now. We invested 350 million over 8 years' time, and we only have written off so far 5 million. And it's already a large part, 250 million, is already being paid back to institutional investors. So the risk is quite low. But if you look at the rating of our portfolio, and it's single B, double B, but if you look at the performance of your write-offs, it should be actually be somewhere in investment grade. But of course, you cannot lift it because it's so. Yeah, we also need to open up, I think, databases, track records to really understand the dynamics in a portfolio in emerging and frontier markets.
So, George, I'm dying to hear your story about how you structured these funds for climate investors. So if you could talk us through how you did this, because this is a little bit of a complex story with different types of investors, different risk profiles, so pay attention.
Yeah, so while we maybe wait for the slide to come up, we are based as a manager in the Netherlands with a small head office, but we have 3 offices across the globe in Singapore, Latin America, Colombia, and in Cape Town, South Africa. We started with 5 people. Now we have grown to 70 people, managing currently a number of funds. We have $1 billion under management across basically the 2 funds on the left that I will talk to. And hopefully in a month's time or so, we will announce or actually have a first close for our second fund for about $600 million. This is all about renewable energy, okay? So our view is to put into the market climate-relevant themes, funds. First one will be renewable energy. Our second fund will be about water, waste, and oceans. And the third fund could be landscapes, agriculture, or sustainable cities, but it will have a climate theme. Now, to respond to your question, Mike, how do we actually structure the funds? So what we've done is we stripped out those types of risks in those phases and allocated to those investors and can absorb it. So when you're looking at real assets, because that's what we invest in real, actual, tangible assets like renewable energy. The development phase, which is the first phase to get a project off the ground, is considered the highest risk. Little capital is needed, but many projects fail. They never reach the finish line, and the finish line for us is to actually start construction.
So we're talking about solar panels or wind farms?
We're talking about wind farms, we're talking about solar projects, and we're talking about small-scale hydro. So it's small water, hydro, and wind, and medium-type sizes. So from, say, 50 megawatts to about 150 megawatts. And I'll show a few examples of the wind farms and the solar farms that we're currently building and operating, okay? So we stripped out that development risk, and we funded that phase with donor funding, so from governments of the Netherlands, the European Commission, but also the Green Climate Fund, the US government, and the Nordic Development Fund. Those are all donors that are funding our first phase, our development phase, through a separate legal entity, which is a stichting under Dutch law. Then the second fund, there we've basically concentrated the construction risk. Also a concern for many investors, they find it difficult to absorb construction risk. So what we've done there, we've tranched the fund in 3 different capital tranches, with a senior equity tranche, with the least risk, with a middle mezzanine equity tranche, and a first loss or a low junior type equity tranche that is also funded by donors, which basically means that if in the future there would be a write-off or project failure, they would be buffering that first loss, that first event, okay? Then if you see who our investors are in the funds, we basically have 4 to 5 different types of investors. I mentioned the donors to take away the hardest risks, but we have institutional investors, primarily in our second tranche, the Tier 2 tranche. And there you can think of KLP, which is the largest pension fund in Norway. We have another Norwegian pension fund. We have a South African pension fund. We have a UK-based pension fund. So there's a lot of pension funds that are looking to invest in our funds for several reasons. And then the third tranche, the senior tranche, is funded by a number of Dutch institutions, including Aegon, that has funded our third tranche, on the back of a guarantee that's been provided by an insurance company. We also have family offices in here for those that believe that we currently need scale. And I think that's one of the major issues that we need to solve. It's all too small, for the most bit. Many pension funds and institutional investors are looking to write 100 million, 200 million, up to $500 million checks. And that we are providing that scale. The second fund is for Climate Investor One, our energy platform, $800 million. Our second platform will be even larger, about $1 billion to invest in. The third phase is our operational phase. That will be funded by a debt fund or with debt. And what we've done here is that, for those that are familiar with project finance, you will know it's very complex and very time-consuming to get a wind farm off the ground. It's all ring-fenced, it's very complex. And also because there's a combination of equity on the one hand and debt on the other. So if you're bringing in banks to finance your wind farm, they will come with their advisors and the due diligence requirements and their contracts that are this big. And what we've said is that we will finance our construction phase with equity only with shareholder funding, much fewer parties at the table, much lower complexity, alignment of interest, and we will only bring in the banks once our wind farms and solar farms are operational, where the banks can do relatively easy due diligence, and we will provide the debt which is needed for returns once a project's been fully operational.
Okay.
Shall I just quickly show a picture of maybe the next slide, just to get an idea of what we're doing?
Can we see
Do I need to
that?
press that? Green? Yep.
Yeah.
This is a wind farm that is close to operations. These are 18 turbines, Vestas turbines, off the shore of Vietnam, in South Vietnam. We've developed it for about a year. We have now constructed it for more than a year, and we believe in a couple of weeks those Vestas turbines will become operational, and we can start then to put debt into those projects. So that's a project that is almost complete. This one is a rooftop solar platform that we funded through a holding company in Singapore. When we provided our equity money, it was 44 megawatts. Currently, there's about 350 megawatts. These are relatively
How much can you power with? How many megawatts were you saying? Just to visualize it.
How many households?
How many households or factories or?
Yeah, that's a tricky question.
Okay.
I think in the Netherlands, but I really stand to be corrected, I think we have about 9 gigawatts or something in the Netherlands for 17 million. But
Okay.
I'm just a bit guessing here. But that's,
So
I think
it's a lot.
It's a lot, yeah. And maybe that number is actually wrong, but I can look it up. So these are rooftop solar installations on hospitals and on industries, for example, on a Coca-Cola rooftop. So that's relatively small for the production, for the energy that's needed there. Currently, this is 350 megawatts, and we're supporting this company to go to 600 megawatts. Here again, we've developed it, we are building it, we are providing debt to it, and now we've received the first bid on this deal. So it's been grown to a size that there's investors that are offering to buy it from us. And that really proves the point about our philosophy, our investment philosophy of developing, building, refinancing, and exiting. We're quite proud that this is now our first exit. Half of our fund has been currently invested, and we believe that in the next 2 to 3 years, we'll invest the full $800 million in these types of projects.
Well, after this, one more.
40 megawatts in India, Siemens Gamesa turbines. And this is another project we're currently building in Djibouti. Djibouti is a very small country in the Horn of Africa. 60 megawatts, also Siemens Gamesa. We're in full construction, and hopefully by the end of the year, also this wind farm will be operational.
And do you think that if you weren't there to do this, there would be a wind farm off the coast in Vietnam or in?
Well, in Djibouti,
in
absolutely
Djibouti?
not. I'm absolutely convinced it's not there. because people consider Djibouti, again, a country where I can imagine it's quite difficult to know where it is. It's a very small country close to Ethiopia. And people think, oh, it must be a scary place, but this has actually presence of 4 major armies in the world, the Chinese and the US and everyone else is there for those geopolitical reasons, so it's very stable. It's a contract in dollars, so there's no local currency risk there. And because of the blended finance structure, we're now able to bring institutional investors to Djibouti who would absolutely never go there. And since this is the first project in the country, it's the best wind speeds. It's the best spot because no one else is still there. Yeah. And we've also procured some political risk insurance in case the government does something that we don't like. Then we have political risk insurance in place for the project as well.
Well, thank you for this illustration. I think this is quite a bit of information to absorb. Is there a burning question? Because then I would suggest to ask you right away. Can a mic go that way? Could you say your name as well?
Yeah, my name is Elina. Hi. Thanks a lot for sharing about your funds. Very interesting. I'm really curious about the climate fund. How do you also assess what's the social aspect of what you do? Because there's always a payoff. There's huge amounts of lithium that has to be sourced in maybe nature areas. There's people living in those areas. How do you really look at what's the local impact of these investments?
Absolutely. Yeah, good question. So for us, I mean, we are starting with the climate point of view, and then we have to demonstrate that it actually does reduce climate emissions, right? If we would increase emissions, it's just a no-go. For that, we are using tools from FMO and from the IFC World Bank to actually calculate, are we actually reducing those emissions? And I think on that side, that's a proven methodology. On the social side as well, I mean, as we know, the world is growing, so very often, almost always, there's people surrounding the actual construction site. So what we're doing there is that we're working with the European and the IFC World Bank performance standards. Those are 8 standards that you have to follow to make sure that either you avoid bad stuff to happen, and if it is unavoidable, that you mitigate it and compensate it. So we in our team of 70 professionals have 5 dedicated ESG specialists, which is quite a lot if you compare it to other funds. And what they're doing is to make sure that, that we are in touch with those communities, that actually support, that we can give them employment, if that's possible, so that we have another buzzword, a social, like a local license to operate, which basically means there's support from the surrounding communities. So it's a moral philosophy that we wholeheartedly support, but it's also just selfishly important to do, because if the community doesn't support what you do, there will be all kinds of things happening, strikes or protests that could hamper your project. So it's a very, very important topic for us.
Good to know.
Okay, Mark, you're working in collaboration with FMO Investment Management.
Yep.
You have a fund, but you do blending differently.
Yes. There's a slide as well, maybe.
Do I have
Yeah. Hold on. Here we go.
Super. This shows how we work. Fund number 1 is the FMO Premium Impact Fund, so that's our fund. So we invest pari passu with FMO. FMO being the big blue block. So what we do is that our investors, like ABN AMRO Mees Pierson, but also charities, family offices, foundations, that invest in our fund. And what we do is we co-invest with FMO in the core portfolio of FMO that Nick described. And FMO Investment Management is advising us on that. And also advising other fund managers like Axiomar and NNIP, Fund 2 and 3, and there's a 4th one as well. And what we do is that on the selected loans, we invest our money through FMO into these projects. And the more funds join, the bigger the arrow, obviously, because the more money gets invested. So where we tend to blend, because there's no first loss tranche involved or no tranching like George described, where we blend is our money gets blended on FMO level. So FMO doesn't invest in our fund, and then we allocate because that has a lot of disadvantages, because it's quite good as a development bank to allocate money, money controls and things like that, taxation. So that's highly preferred to invest through FMO. So that's where the blending of the money takes place. And we blend or cooperate with FMO for the expertise of FMO. Because if I want to set up a emerging market private loan fund that's going to invest in emerging markets and frontier markets, I can try to build my own team, hire the right type of people and get all my processes in place. Or I work together with FMO, where there's, 750 people in The Hague and 50 years of experience. I'm never going to, even if I want to, with all the money in the world, probably not able to replicate what FMO has done already. So this is definitely our preferred way to blend together with FMO.
And who are your investors?
Yeah, so it can be private banks, family offices, charities.
And in terms of return, how well is this performing?
Yeah, it's a floating rate product, mostly floating rate loans. So since launch, it's 3.5% net of fees in dollars and 1.5% in euros. So that's quite competitive, of course, when you compare it to traditional fixed income. And also, if you, like Nick already mentioned, when we set up the fund, we also had to estimate what the risks were, of course. And given the fact that FMO's track record on its core portfolio, and we only invest in the core portfolio, the loss given default is 0.4% per annum. And that's already taken into account, of course, when I mentioned the net of fee return numbers. So that's very acceptable to us and to investors.
So you don't need a separate fund with a nice safety net provided by a donor?
Not for our investors, no.
Okay.
But I can see the point why, like an insurance company who has to deal with Solvency II, they're not allowed to make the qualitative judgment if they find this 0.4% acceptable. They have to deal with Solvency II. So if it makes sense to tranche and have a first loss tranche in there, which solves the Solvency II issue, I could very well see this tranching. But for the type of investors we have in our fund, it's not needed.
Okay, before we have some questions for the audience, instead of hearing your questions, I'd like to hear from Nick about what he's working on, this new fund.
Yeah, it's a new initiative, and indeed, like Mark is saying, we had a lot of conversation with existing investors, also asking them, do you need a first loss tranche in your investment? Could you do bigger size? And what we see with, there's one investor who invested in our institutional fund, it's Alecta, the Swedish pension fund from Sweden. And they're now familiar with our track record. They did a lot of due diligence on us. And they said, well, I also need to pay for that first loss. So I see your track record, so we don't need this also for our capital requirements. Now, this new initiative is with the large insurance company. And they look at it from a completely different perspective lens. So they really need to look at, okay, what does it cost in terms of solvency? How much capital do I need to keep for this investment? And it doesn't make sense to do it on a single B or double B, because then I got all other alternatives to do so. And the more you go down the risk curve, the more upside they need. So they rather go for private equity solutions than this. So you want to be in the bucket of investment grade or above. And for that, of course, they need a first loss tranche, which actually also FMO is quite happy to provide, because we are very comfortable with our portfolio. We've seen our track record, our expertise. And also what they also like is, of course, the volume, the amounts we can offer. Now, but I fully concur also with Sjors on the discussions you encounter with the various counterparts. And what we see with institutional investors, all our institutional funds are now hard currency, so only euros and dollars. Also below a certain risk rate, they are excluded. So the more riskier you go, and that's also the nice examples which Sjors gave, the more they are excluded. And then you need to work with kind of first loss kind of solutions to make them comfortable and get them along in the journey.
Okay, we have two, having heard these three stories, we have two questions to the audience. So I would like to see, we made two statements and we'd like to hear what you think. So for the viewers online, you can is it coming? Well, meanwhile, there is a burning question from one of our viewers. He said, I worked in OECD on what then was called aid credits. Do you know them? Aid credits? Now blended finance. Tied aid credits were used to secure preferential deals for national champions through aid that had to be spent in the donor country. It was seen as a waste of development aid. What has changed?
This is not a discussion about tied aid. We're not tied to any Dutch or any other export products. So that's I think it's a completely different concept.
Yeah, so the donor money that goes into...
The aim of the donors is not to promote any form of exports. The aim of the donors is to multiply their ODA funding, which is about $150 billion a year. That's very limited money. And what they're trying to do is to catalyze commercial investors alongside themselves by a multifold of that amount. That's their aim. They're trying to close that very large financing gap of about $2.5 trillion a year to achieve the sustainable development goals. They don't have the funding, the donors themselves, the governments. It's only a drip in the ocean, and they're trying to tap into the large pots of capital. That's their aim, not to create exports.
Okay, thank you for this quick answer. We have here a statement. It says, investing in private debt in emerging markets alongside specialist development banks offers enough risk mitigation for institutional investors. This is basically following on from Mark's story where they're blending at a private debt level. So I see that lots of institutional, I don't know if institutional investors are actually answering this question or we are answering it for them, but we agree that it should be good enough for institutional investors. Does that surprise you, that outcome? Or?
No, because it's also about the not only the capacity and the knowledge. Development banks, look at all the development banks in the world, but also the network experience, and also strong network with either clients locally or with developers. Look also what George is working with. If you have good experience with them, but it's a different ball game, and it's also a different way of approaching it. And also, ESG is also a very important topic. Also the same with FMO. Out of the almost 700 people working for us, we have 45 ESG specialists. We have risk classification. I mean, no other institutional investor has so many ESG specialists involved, but they're also quite high risky. Then you rather invest together, I guess, with the development bank than trying it yourself, especially in fragile states.
Let's move on to the... Well, I guess on the basis of this, you have a point of reaching out to institutional investors.
What the disagreement is about.
Is there someone in the room who disagreed? No, we can't ask, unfortunately. Let's move on to the second statement. Long-term institutional investors should make blended finance part of their allocation, even if that may cost a few percentage points in return. Well, that's a convincing outcome. Well, I don't know how many people voted, 11. Well...
All the more convincing now.
I'm indeed wondering who's voting. Is it from the institutional investors or elsewhere?
Yeah, that we don't know.
Yeah.
So this sort of actually surprises me, because when you speak to institutional investors, they have a lot of criticism on blended finance. They tend to mention all the barriers that there are: a lack of liquidity, small ticket sizes, complex process, no track record, credit rating, what have you. But here, well, maybe we're deciding for them that they should go this way.
That's encouraging.
Yeah, it's encouraging to knock on a few more doors, I guess. Well, I'm not sure we're so representative, though. But maybe we should do a proper survey on this. What I would like to know, I mean, in terms of... Well, there's lots of ideas about blended finance. What would you think are the main misconceptions that there are?
It's the barrier we run into mostly is about the risk perception on what we do. And I always give the example. It's for investors like us, investing in emerging frontier markets is new. It can also be a diversification in your portfolio. So it's for us very easy to get an appointment somewhere, a meeting to explain what we as a development bank do. And maybe the same goes for you, George, but that's about 70-80%. We can actually have a meeting, but then to turn that into actually an investment is less than 1%. And then you get into barriers like liquidity or a risk return, and then risk return expectation versus really the risk, and taking a real careful look at track records of all the development banks. So there are also databases available. James database, for example. Then you look at IFC, EBRD. If you look at the whole, all the development banks together, they have a portfolio of around 100 billion. So they invest roughly 16 to 20 billion each year. So there's a lot of data and experience available, which can give you quite a good idea on how the risk looks like. And then, of course, the other side is, can you do it in terms of solvency? There's a question from the audience.
Laura.
Yeah, Laura Semius. I have a question regarding the statement that Nick Vesemius just made. I think it's very interesting. Are you actually somehow saying that maybe the regulations are not adapted? So if I look at if I hear about the track record and the experience of the FIs and the databases that actually show that the perception of risk is higher than the real risk, is solvency and Basel, are these regulations actually properly made?
Yeah, good question, of course. It's all about indeed regulation, not understanding the portfolios, because the countries where we are active are not rated, and all our clients are not rated. So we met that together with a system we developed with Moody's. So that's one part, and also all kind of risk mitigants to if you co-invest together with a development bank. And I think in the old days there was capital relief for banks. If they would invest together with a development bank, there would be also in exactly the same way our funds participate in FMO loans. But that's not longer the case. And if you want to move more capital towards the SDGs, you need to look at regulations.
I have a question here, and I think maybe I give that one to George. What's the secret sauce to dealing with public and institutional investors, i.e. red tape, short-termism? How do you get them on board? What's your trick?
I think you need to work with those institutions that are really that are courageous and actually have a view. And what I've found is that the institutional investors that are on board with us and the family offices are not coming from the Netherlands. They're coming from Scandinavia, and I see that they are really at the forefront of impact investing. For them, it's really important to set audacious goals, to set targets, larger targets, and then they will invest. With that point of view in mind. In the Netherlands, what I've struggled with is that I miss the sort of the sense of urgency also, because the context of all of this that we're doing is the fact that there's a warming planet, right? It's 1.1 or 1.2 degrees already increase. There's fires and floods everywhere. It's very scary. And what we're trying to do in the next 8 years is to curb those emissions so we can avoid going to 2, 3, 4, 5, 6 degrees, because then, then the hell will probably break loose. That's the context, and I don't see that, especially in the Netherlands, sort of that type of urgency. We are in a war against the climate. We are still in a war against the pandemic. We really took very strong measures because we can see it in our face today at large scale. The problem with climate change is just it extends over a longer period of time, and that reduces people's sort of tendency to act, and that's what I miss here in the Netherlands in the institutional investors. I see it much more in Scandinavia, and I also see it in the United Kingdom a little bit more.
And they're willing to give up a little bit of return because obviously
There is
pension
no
funds
giving up of return. I mean, the people were concerned about risk. We stripped out the risk. We took away the development risk. We took away, to a certain degree, the construction risk by putting in donor funding. Some people think if you're putting in donor funding and the government is supporting it, there must be some political thing there. And the answer there isn't. They have never seen any government interfering with our independent management. They have questions on impact. And so that is not the case. So we are in our second tranche, we're delivering a 15% post-cost and fees target in US dollars. That's for infrastructure a fantastic return.
Yeah.
Okay, so there's no, in my view, the structure is there, the scale is there, and now we need like-minded institutional investors that are not passive but active and saying we're supporting these types of vehicles. And I see that outside the Netherlands, but in this country so far not as much.
I hope they are tuned in to hear your pitch here. Mark, you mentioned another way of getting to scale, and that is there are different investment funds that are already listed for wind parks, etc., and that's going the way of listed vehicles. That makes it easier.
Yeah, I mean, what Nick described, one of the issues is sometimes liquidity for investors. And we have another mandate, nothing to do with FMO, that Jan Willem mentioned earlier, that has a rather liquid mandate itself as well. But we want to make the highest impact, and the highest impact can be made usually in private market impact investments in equity, which obviously is illiquid. So what we often do there is invest in closed-end exchange-listed trusts like Greencoat, UK Wind, or Trig. And these have almost exploded in terms of popularity. When we started to invest, they were like 300, 400 million in size, and now they're 3 billion. So literally a tenfold in a couple of years. And that's obviously, if it's exchange-traded, it makes it available for everybody. The earlier question, or the question in the earlier panel, about a threshold of 2.5 million or whatever. I mean, if it's listed on exchange and worth €100 a share or 100 sterling in the UK, it's not available for everybody, but it lowers the threshold tremendously, and it also has something to do, but that's more up to the type of investor. The mandate is obviously usually quite strict when it comes to liquidity. So it really helps, and also the systems there are very big allocators like other banks, because ABN Mees Pearson can invest in our funds, so they're a bit more flexible. Our fund has monthly liquidity, but that have to deal with exchange-listed investments. So that will open up a whole range of new investors into impact investing. So that will be very beneficial, and at a size of 3 billion per exchange-listed fund. That's even for very big investors, obviously big enough to have enough liquidity to actually classify it as a liquid investment. So that's a huge growth market I see and face, and I'm investing in it every day. But if it works for us, it should work for more people.
Nick, do you share that view? Or do you see some regulatory issues there?
Yes and no. So I fully agree also with Mark. You can open up the market for retail, family offices, also the investors who need liquidity. But if you do an institutional fund with maybe 5 investors, and let's say they all take 20% each, you create liquidity and they want to get out. Yeah, especially the portfolio, which we all have, is not liquid. It's very difficult. And B, you get valuation issues. So we asked that also to a couple of pension funds, would you like this to be listed? But then again, if you maybe remember the graph I showed, if you need to benchmark it, you could get a lot of volatility in your portfolio. And that's something they don't want. They rather have a closed-end fund. All the funds, they have an investment period of 1 or 2 years or 3 years, and they all run off within 10 or 15 years. So that's how they get their liquidity back. So there's a liquidity aspect. You're not locked up for your full amount for 20 years.
Well, we had one more question for the audience, and it was really about, what is it that you need to invest in a blended vehicle? So maybe we can see the answers. It was an open question, so people were going to put in what they found their top 3 priorities. requirements. So we can see here enough spread, reporting, scalability, risk return, risk profile insight, and track record. More women investors, or more investing into women. I'm all for it, but a cornerstone investor, that's usually what happens, right?
I would say that most of this is there. The track record is now increasingly there. Well, I don't know. Do you want us to respond to it?
Yeah, please.
I mean, so the track. I mean, FMO investment management has track record. We are 5 years track record. Not sure if that's sufficient track record, but it's not. We're no longer a first-time fund or a first-time manager. We always have cornerstone investors. We report on a quarterly basis. We have scale because it's $1 billion. I think that's sufficient scale, I would hope. Risk return is really good because 60% of the fund has a capped return, so all the upside goes to 40% of our funds. So that's there. Risk profile insight is delivered during due diligence. People can see all our transactions, all our approval papers. So I don't think that's an issue. So I see a really a promising future ahead.
Yeah. All the answers from the audience were actually pretty positive. Well, in the US, there's currently this debate about how to get all these trillions in getting their infrastructure back up to normal quality levels, I would say. And I read a comment of a US professor at Columbia University suggested, I don't know, well, probably you all know Fannie Mae from the financial crisis. And she suggested a green Fannie Mae, i.e., public money should be used to buy up risky investments in green products, and they should be repackaged as standardized bonds, and then mainstream investors can invest in those bonds. And I put that to George, and he said, well, we're actually working on something similar, and it doesn't have to be Fannie Mae.
Yeah, so if I understand correctly, how that works is that one government dollar is structured such that it can attract a commercial dollar. So that's sort of a leverage factor of 1 to 1. That's quite a waste, I would think, right? Because you can have much better leverage factors that one donor dollar can attract 5 or even 10 or $20 from the private sector. That's what you're trying to do with blended finance. So I think there's more efficient structures out there. What we are currently doing is we're structuring our third fund, which is a debt fund. And what we're trying to do there is to offer that to institutional investors so they can actually, invest at scale. Very often these investors don't have the teams to go and write smaller checks to smaller companies, very much like what FMO is doing. FMO has the in-house team, so have we. And there we're sizing the fund, I think, from $1 to $3 billion. With probably also a credit enhancement. Again, also what Nick is saying, to get the credit rating from single BB into investment grade. So we're looking for that portion of Fannie Mae money or donor money to bring it to a BBB rating, and then to fill the rest with commercial funding. So I think it's a way that we do it, but it seems like in a more efficient way than what a green Fannie Mae would do.
Well, maybe you should branch out to the US. There's lots of possibilities there.
I think...
There is another question. Excellent.
Yes, just a very different question, but we're in the Climate Week and I haven't heard anything about investing in biodiverse forestry. And the word forestry hasn't fallen, it's only renewable energy, and that's obviously, fantastic, and we all need that. But we also need forest to capture and to get our biodiversity up. Is that something that's on your radar screen, or just out of curiosity? I know it's a lot more difficult because there's not such a track record and it's a much longer horizon, but...
I think, Nick, I read that FMO has recently launched several forestry funds.
Yeah, we've been looking for forestry also when you still were at FMO, at forestry investments, but they're still very high risk and also, how would you say it? It's also, it's not liquid, it's a long-term investment, also high risk. So far we have not added to our institutional portfolio. We also do that with donor money. Also, FMO is getting money from the European Commission, for example. We can have government funding available for it. But so far, it's still in our high-risk bucket within FMO. But definitely, if you look at CO2 emissions, an investment in a forest is really the way to go.
Yeah, and much more yielding from a CO2 perspective than renewable energy. I fully endorse your point. I think it's absolutely valid. The biodiversity crisis is probably an even bigger crisis than the climate change crisis. So what we've done with our second platform, which is focusing on water, on waste and on oceans, in that oceans bucket we've reserved a pool for what we call nature-based solutions. And that's indeed a very difficult market still. That's why the amount is small. But what we're trying to do there is to support those projects that support biodiversity and can also yield a private return to investors, because you need a business case, you need a revenue line. And that could, for example, be a mangrove forest that you invest in on the basis of which you can issue carbon credits. Yeah.
Any other questions from the audience? Richard. Two more. Here.
Hi, Tanya from IDH. Just curious on the last point that you guys made. Is there a blended finance 2.0 for these much more difficult pieces of the climate puzzle that need to be solved with different types of capital? What is the next financial solution for things like biodiversity and sustainable land use?
Yeah, I think what is lacking there is firstly scale. The projects that are out there are small. And investors want to write bigger tickets. They don't have the capacity to write small tickets. So the question there is of scale. And the second thing is that we need to be able to work with innovative models so that we can actually determine and create a revenue line. So I can try to, there's many projects to invest in and say this has biodiversity benefits, but it needs to produce a service or a good or a service that someone else is willing to buy and pay for. And that's the issue. So our contribution in Climate Investor 2 is to work with 5 or 10 of those innovative business models and then to try to bring them to scale. Our development fund can do that. At the expense of non-commercial funding, we can build those pilots, and once they've reached scale, we can move them to the second fund. So that's what you need.
Richard. Mike over there.
Yeah, thank you. Hi, Richard Azania. Just two related questions. Do you ever work with, or is it possible to work with grant money in order to even further reduce the cost of capital? And then in terms of the positive impact locally, as opposed to just investors, could you then, with a reduced cost of capital, also, for instance, have a reduced price of electricity that you sell for the benefits to be split not just on the investment side, but also on the user end? What do you think? What's your thinking around those two things?
Yeah, FMO works with grant money, but we use it a lot more for capacity development. So you can actually help to develop, or the local borrower can actually retain a consultant to help them develop something. We're not financing, we're not the owner of the project itself. What we do have, and we work with that, we experimented with that, if certain milestones are achieved in terms of what they need to implement could be an ESG program or whatever they need to implement. So ESG risk is lower for FMO, that they can also get a reduction in the margin of the loan. So it does get cheaper, and they can actually give that through to their end investor. Because of course ESG is also a risk, and if you can improve on that, you can do something with it.
From a donor perspective, grants are not really popular. From donors. They prefer to issue what they call financial instruments, because then the moment you have granted $1, it will never come back, and they cannot reuse it for something else, and the multiplier effect is lower. So donors are not really very much in favor. There are exceptions. For example, in Nigeria, we've received an allocation from the European Commission again for very difficult projects. So there we can indeed use certain grants for certain specific issues to indeed lower the cost of capital and then build a project around that. And an example could be like a transmission line. So we would be building the power project, but a transmission line is in a very bad state, and you need to dispatch your energy through the grid to users. That could be a quite useful use of grant. But that's an exception rather than the rule.
So grant money for project development is not really
We don't do it. We always charge. We want our capital back for project development with a profit if it's successful. The fund itself doesn't have to generate a profit to its investors. So we will incur losses on certain projects during the development stage, and we will compensate that with profits on other to just make it revolving, as we call it.
Okay, yeah. Any more questions? Laure. Yeah, I would like to give the floor to Laure Seamus, because she is the managing director of the National Advisory. Sorry, now I say it all wrong. You say it better. But she has something to say to us because she needs our help.
Thank you, Maaike. So I'm Laure Seamus. I'm the Managing Director of the Netherlands Advisory Board on Impact Investing. We were established last year, and what we do is actually bring stakeholders together of the different groups of stakeholders in the Netherlands and internationally also with the Global Steering Group on Impact Investing. What we're going to do is actually we're launching a survey tonight or tomorrow, depending on the technicalities. And we're going to do a mapping of the Dutch impact investing sector. A quantitative analysis with sizing, with all the assets under management. So I would like to invite all of the participants in this room and online to respond to the survey. And a qualitative analysis where we will ask the respondents and volunteers who would like to have a follow-up interview with us what they think about the barriers that limit the scaling up of impact investing in the Netherlands and outside of the Netherlands, by the way. So I want to invite all of you and the people watching online actually to follow us, the Netherlands Advisory Board on Impact Investing. You can find our you can find us online, and otherwise look for me on LinkedIn. And we will, on our social media, on LinkedIn, but also in many publications with many networks like BIM that we saw this afternoon, but also the GIN and many other organizations, we will launch the survey tonight or tomorrow. So invitation to respond, to have as broad as possible a picture of the sector. Thank you.
But before, this is for Dutch participants only, so we don't ruin the results with French asset managers or... But before you fill in her survey, please fill in the survey that you get at the end of this session, because we love to hear your feedback on this session and on Impact Investor, because that's very valuable to us. One more last word to our panel. COP is coming up. Every day I get emails, press releases of asset managers announcing new pledges and what they're doing to contribute to climate change. What do you see? I mean, it's all going to be about how to execute on all the promises that governments have made on how to address climate change. Financing is a huge part of it. What would you like to say about, well, how we're going to be bombarded with all these initiatives and how we try to filter what is important and not?
Yeah, indeed. For me, climate change is global. If you look at, also especially towards emerging markets where the GDP is highest, that's if you exclude that from your mandate and you don't look at emerging and frontier markets, then there's something missing in your space. So, it's more like an open invitation to investors. We can think of barriers, but how can we help you to overcome them and make this happen? Because you mentioned the billions to trillions agenda. Also, all the development banks together only have a limited amount of capacity. But we do have the capacity to invest and also alongside institutional investors. So, open outcry to let us know what you need.
Mark, what were your final words on this?
The biggest impact I can have is raise more AUM for the fund. So that's my motivation to get indeed the financing to work.
And what do you hope to come out of COP? Do you have a view on it?
No, more awareness, and that hopefully they'll definitely point out that investing is a good way of doing it, because in my particular case, I can do a lot of home. I can do a lot at home, and how I live. But obviously, my biggest impact is making sure the fund is a bigger success. That has way more impact than I can make myself. So that'll be my focus.
Yours.
Yeah, I think for those that are preparing for COP and those institutional investors that are trying to make a contribution or an announcement, I would encourage those to be more specific and concrete, and to make it very big, and to do it today or tomorrow, and not in 10 years from now, because we don't have the time. That's what I would say.
Thank you. Very clear message. We've come to the end of this session, so I really would like to thank you for participating, all your questions, and for being here. It's great to be with everyone in a room. We have a survey at the end of this session that you get sent, or I think even there's a handout when you walk out of the room. And I think now it's really high time for drinks. I really like to thank the team for organizing this, because they put in a lot of hard work. And thank you, our panel.